Hey, what's going on, everybody? It's Monday, May 9th. Another big down day in the market. But I got a lot to say here. I want to let you know I got a lot to say here, and I'm going to go through it. First and foremost, today is Monday, so I sent out the new issue of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. All right, let's get into it. Big down day in the market today. We took out finally Dow and S&P, NASDAQ. They all took out the May 2nd lows, but I was pretty sure that was going to happen. Look, here's the thing, folks. Number one, I got to break this all down. Number one, for the month of May thus far, we're talking through May 6th, that was Friday, the latest statement day off of the daily Treasury statement. Federal government's still running a surplus. As a matter of fact, it increased to 38 billion from 31 billion. So net fiscal flows, when I'm talking about the net flows, I mean the leading spending minus the taxation. I mean, it's just going right back to the government coffers. I mean, so there's really nothing. Remember last week I did that thing, I said there was a big hole in the swimming pool and we called in the masonry guys and we patched it up and now the water's flowing back in. Well, I jumped the gun a little bit on that one. The water's flowing in, but it's still draining out. There's still a hole at the bottom of the pool to the amount of 38 billion. That is our surplus. That is the federal surplus so far for the month of May. Now, May will revert back to a deficit, and that should happen soon. I think we'll probably see that flip back to a deficit this week, and we need that. I mean, we need to see that swimming pool filled up. By the way, this is just also an education you should be getting in surpluses and deficits, and I think this is a very obvious lesson in how a surplus is negative. It's negative for the economy. We saw negative economic growth in the first quarter. It's negative for financial markets, for stocks, for risk assets, because it's a drain. This is really a liquidity drain. Okay, I've said this many times. The stuff that the Fed does, quantitative tightening, all that is a recomposition of the financial assets in the economy. Okay, you get less reserves in the banking system and more treasury securities. Okay, big deal. Your net worth has not changed. As I made the analogy, I said, look, if you have $10 million in treasuries and I have $10 million in cash, do you think you're poorer than me? Do you think your financial position has tightened? I doubt it. If you had $10 million in treasuries and I went up to you and said, you're poorer than me because I have 10 million in cash, you'd be arguing very strongly, that I was a quack, that I was a fool. So QT and QE, that does nothing. But this is a real liquidity drain. The government spends the money into the economy, but then it sucks it right back out and then some. And then some to the tune of 38 billion. And in April, they ran a 330 something billion surplus. So, you're talking about 360 billion drain between April and the first, 5 days, the first week of May. I mean, that's a big hit. Okay, we need that water to flow back in. We need that hole at the bottom of the pool to be patched. Now, okay, so I said that. So I'll go on record as to say, until we see that whole patch, until we see the federal budget now flip back to deficit for the month of May, stocks are going to have a very hard time rallying. Let me point out a couple of things. Number one, and this is a minor thing, but maybe not so minor. Because the investors now in the markets are really, really hyper focused on inflation and interest rates, and that's really been the thing. This week, and I think I mentioned this in my video on Friday, this week on Wednesday and Thursday, we're going to get some inflation data, and it's going to be good. Okay, their forecast for CPI for April up 0.2%. All right, in March it was up 1.2%. And PPI, producer prices, which comes out on Thursday, that's supposed to be up 0.5%. And last month it was up 1.5%. So, I mean, that would represent a significant deceleration in price increases. And I think the bond market is going to look at that and it's going to feel good. And by the way, as long as I'm talking about the bond market, I should mention that Fed fund futures. Remember Friday I said they started to price in a 75 basis point hike at the June meeting, even though Powell said that was not something under consideration. Well, guess what? Today, Fed fund futures were pricing in a 50 basis point hike. So I think they listened, or they reconsidered what Powell said. So today it jumped back, or it fell back to a 50 basis point. Probability was like 86.2% or something like that. So back to, I think, where the expectation or where the forecast should be. It got a little crazy on Friday, and people got, it shows you the emotion in the market right now. Like, the emotion is really, really crazy. Now let me talk about this. This I think is, because it's very easy to get caught up in this emotion, and all you hear about is market crash and you know, hyperinflation and stocks going down and market crash this and market crash that, you know, so like hard to escape. And even me, I have to say that, you know, when you're bombarded by this stuff, you know, it's really difficult to create that kind of emotional barrier to separate yourself out from this constant barrage of negativity and hyperbolic headlines and everything like that. So, but you know, you have to try to do that. If you're going to stay sane, if you're going to stay focused on what's really important, and if you're going to spot the opportunities, and let me just segue quick, opportunities, let me just mention, like right now, some of these tech stocks are ridiculously cheap. Like, you're not going to see these prices again, maybe forever, or maybe for a long, long time. I mean, this correction, you look at stocks like Nvidia and, you know, Apple and Amazon and all these bellwether leading big tech companies. I mean, the correction has been enormous. These stocks are trading like value stocks. You're not going to see these prices again. So, you know, you could panic, you could sell, you could go crazy, or you could, you know, step back and say, wow, this is an opportunity of, you know, I don't know, of a lifetime, but a big time opportunity. Now, here's the thing I want to talk about, all right? I just looked today at second quarter GDP estimates, okay, economic growth estimates. The Atlanta Fed already has its second quarter GDP growth estimate out, and it's estimated at up 1.8%. Let's round it off to 2% second quarter growth. 2%. 2% economic growth is pretty much where this country's economy has been in trend for years and years and years prior to the massive, you know, pandemic related stimulus boost, you know, when we got to 10% and all that stuff. So 2%, we're basically going back to what was normal growth for a highly developed economy like the United States without the stimulus. But the market is trading like we're having a 30% contraction, a 30% collapse in economic activity. I mean, the market, by many measures, is literally trading the same as it did in the March-April 2020 pandemic crash. But that was a 30% contraction in the economy. And now we're growing, the economy's growing, okay, albeit it's not like really rapid growth, but at the same time, 2% growth, that's going to bring inflation rates down. I mean, it's just crazy what's going on. It's literally insane what is going on right now. I mean, you're looking at, we had that one quarter, I talked about this the other day in my video, you know, that first quarter was dragged down by two things. Inventory accumulation was less than the fourth quarter of 2021, but the fourth quarter of 2021, inventories increased by a record amount. Huge increase in inventories because some of that supply chain stuff started to open up. So first quarter, you still had a big increase in inventories, but it was less than that massive increase in 2021 in the fourth quarter. So that was a subtraction. But big deal. It was still really, when you think about it, a positive thing. Companies beefing up their inventory. They would do that. Why? Because they see demand. Second thing was the trade deficit. Okay, so the trade deficit is a subtraction. I talk about that. That's when the money flows out to the foreign sector. But that's also a reflection of strong demand. If we're buying foreign goods, that means we have the money to buy those foreign goods. Yeah, it's going to them, the income, but it's also a barometer, and it shows us that there's strong demand. So I look at first quarter contraction was really kind of like a meaningless contraction. It didn't show any kind of real weakness. As a matter of fact, personal consumption expenditures were really strong, and business investment was really, really strong. And now we're coming into the second quarter when growth is going to be like 2%, but the stock market is trading like it's a 30% collapse in GDP. It's crazy, folks. It is crazy. It's crazy. When this thing turns around, this is like a rubber band, so stretched. When this thing turns around, I don't know if we've ever tested these limits, these trading limits on the New York Stock Exchange. I think 2,500 points on the Dow or something like that. I think we could have a limit up day when this thing turns around, because it's absolutely ridiculous. So anyway, that's my update for today, folks. Please take advantage of these amazing prices in some of these bellwether, big name tech stocks. You're not going to get an opportunity like this again. I mean, put this stuff away for your kids, for your grandkids, for yourself, for your retirement. I mean, this is unbelievable. This is really, really incredible. I mean, you're just not going to get an opportunity like this again. So, all right, folks, that's it for today. I hope you enjoyed the video. Please like and subscribe, and go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Bye.